Most traders act too soon. They see a little life on the tape, a few upticks, a bar or two that looks like strength, and they rush in, eager to be first. They buy early because they think strength is something you can spot with excitement, with speed, with a bit of luck. But the truth, my friend, is that real strength is never loud in its beginning. It's quiet, it's subtle, and it always gives itself away to the patient observer who waits for confirmation, not just motion. Now, let's talk plainly. Why do 90% of traders buy too early? It's because they're watching price and ignoring effort. They see the market rise and assume that means demand. But remember what I've always said, price alone tells you nothing. It is the relationship between price, volume, and time that reveals the truth. Price may rise on light volume. Does that show strength? Not at all. It may show the absence of sellers, not the presence of committed buyers. Do you ever find yourself jumping in because you fear missing the move? That little whisper that says, "It's going without me?" That's the emotional weakness that causes most traders to fail. They mistake activity for opportunity. They think that strength means speed, when in fact, the strong hand always moves slowly, methodically, and with purpose. Let's think about what real strength looks like in the market. It's not the first rally after a decline. That's usually a short, covering rally, the automatic response of weak hands who've been frightened out of their short positions. True strength appears later, after the market has absorbed the supply, tested it, and shown that sellers are no longer in control. The professional operator, the composite man, will test the market again and again before showing his hand. He wants to be sure there is no more stock available at lower levels before he advances the price. When you see that quiet period, when the volume dries up, the spread narrows, and the market refuses to go lower even on bad news, that's when you're seeing the early signs of strength. Not when the crowd is buying, but when the crowd is bored. That's the moment when the smart money is finishing their accumulation. You must train yourself to see what the public cannot. The average trader sees movement. The Wyckoff trader sees intention. Ask yourself this: who is behind the movement? Are the large interests supporting the market or merely allowing it to drift? When you learn to answer that question, you no longer have to guess. The big mistake comes from confusing potential with confirmation. Many traders see a spring or a rally off support and assume that's enough. They forget that a spring must be tested. A rally must show follow-through. Strength must demonstrate itself through both price and volume. You must wait for that sign, the moment when the market proves that demand is now overcoming supply. Patience, my friend, is a trader's greatest capital. Not money, not margin, but patience. Money follows patience always. Most traders are broke not because they lack skill, but because they cannot wait. They want to trade today, to prove they can win today. They forget that trading is not about winning trades. It's about positioning yourself where the odds are overwhelmingly in your favor. Think about the great operators. They never chase. They never rush. They let the market come to them. When the accumulation is complete, the tests are passed, and the last of the sellers are gone. That's when they step in, and when they do, they buy with conviction, not with hesitation. They're not guessing, they're confirming what they already know. Do you see the difference between the early buyer and the professional? The early buyer acts on hope, the professional acts on evidence. The early buyer fears missing out, the professional fears being wrong. And because of that, the professional waits for the sign of strength that cannot be faked. Now, what is that real sign of strength? It is when, after a test or a shakeout, the market rallies with wide spreads and increasing volume, demand stepping in and showing itself unmistakably. It's when the price moves up easily, without effort, because there is no more supply to resist it. That's when the big interests are supporting the market. That's when you must be ready. Most traders can see the spring. Few can wait for the confirmation. The market loves to trick the impatient. It loves to show you what you want to see, just enough to make you act too soon. It's only after it shakes out the weak hands that it moves in earnest. You've seen it happen, haven't you? The market dips a little below support, triggers stops, and then reverses sharply upward. The crowd cries foul, but the composite man smiles. He's cleared the path. You must learn to think like that composite man. Imagine you are the one building a position. Would you show your hand? Of course not. You'd accumulate quietly, testing the market's supply, shaking out the weak holders, and only then push the price upward once resistance is gone. That's why you must not buy when everyone else is excited. You must buy when the professionals are finished preparing. Every campaign, whether in stocks, commodities, or currencies, follows the same rhythm: accumulation, markup, distribution, markdown. It's a cycle of preparation, action, and liquidation. And within that cycle, there are always signs, clues on the tape, that tell you who is in control. The amateur buys in the preparation phase because he mistakes it for the move itself. The professional waits for confirmation that the move has truly begun. Have you ever noticed how the market rewards the calm and punishes the restless? The calm trader studies the structure, waits for the test, and enters when the odds favor him. The restless trader jumps from signal to signal, forever seeking certainty but never finding it. This game is not about certainty. It's about probability, structure, and timing. Let's talk for a moment about wealth building. Wealth in trading does not come from a few lucky trades, it comes from discipline. Knowing when to act and when to stand aside. Standing aside is a position too, though most traders forget that. The more you learn to wait for that genuine sign of strength, the more your trading account will reflect it. You'll take fewer trades, but they'll mean more. You'll be aligned with the market, not fighting it. And that's another truth. Your mindset must evolve from wanting to make money to wanting to understand the market. When you understand it, the money follows naturally. But when you chase money, the market will punish you every time. The chart is a mirror of your patience, your discipline, your temperament. It reflects not just price and volume, but who you are as a trader. So ask yourself, are you reacting to price, or are you interpreting behavior? Are you part of the crowd that buys too early, or are you among the few who wait for proof that strength is real? When you learn to wait, to let the market confirm your analysis, you move from guessing to knowing. And in this business, knowing, even a little, is worth more than all the hope in the world. Now, as you study your charts, start looking differently. Don't ask, is this going up? Ask, who's in control here? Don't look for excitement, look for absorption. Don't be seduced by speed, be guided by structure. Most traders mistake early price movement for genuine strength. It's one of the oldest habits in the market, and one of the most dangerous. The average trader sees a few rising bars on the chart, feels that little spark of excitement, and rushes to buy, convinced they've caught the beginning of a big move. They believe price alone is the signal, that when it starts to rise, it must mean strength. But price is deceptive. It moves for many reasons, and strength, true strength, rarely shows itself in the first movement. When you see price rise quickly after a decline, you might think, there it is. The bottom is in. But ask yourself, why is it rising? Is it because large, informed interests are entering the market, or is it merely the covering of short positions? Most of the time, it's the latter. The first rally off a low is nearly always a reflex, a mechanical response as weak shorts scramble to cover their trades. That buying may push prices up, but it's not the kind of buying that builds a sustained advance. It's temporary, emotional, and shallow. Do you ever feel the urge to act when you see a strong green candle form after a long decline? That's the same impulse that catches most traders. The mind mistakes relief for opportunity. After watching prices fall for days or weeks, any sign of upward movement feels like a signal to act. But markets don't turn simply because traders are tired of seeing red. They turn when the supply of stock in weak hands has been absorbed by stronger hands, when the selling has truly run its course. Here's where the Wyckoff principle becomes vital. We don't read the market by price alone, we read it through the relationship between price and volume. A rally on low volume, even if it looks sharp, is not strength, it's lack of opposition. There's a difference between no more selling and strong buying. The first creates a bounce, the second builds a trend. You must learn to tell the difference. Imagine a stock that's been declining for weeks. One morning, it gaps up, rises sharply, and closes near the high. The public sees that and calls it strength. But when you look closer, you notice the volume isn't increasing, it's drying up. That's not demand stepping in, that's sellers stepping aside. The rally is hollow, fragile, and easily reversed. When the market meets fresh supply again, it falls just as quickly as it rose. The real sign of strength comes later, after that early burst has been tested. Strength reveals itself through effort and result. A professional trader waits for the market to prove that demand is now capable of absorbing supply. He looks for wide price spreads on increasing volume, where the advance holds rather than fades. He watches for the character of the reaction that follows. Does the market give back all the ground it just gained? Or does it hold firm, showing that selling pressure is diminishing? Think of the early price movement as a question, not an answer. The market is asking, is there still supply down here? If the next reaction comes on low volume and narrow spreads, the answer is no. That's when strength is confirmed. But the impatient trader has already bought on the first rally, using up his capital before the market has revealed its hand. Have you ever noticed how the professionals seem to buy when it feels too quiet, too uncertain? That's because they understand that true strength is born from quiet markets, not from noisy ones. When prices start to move upward easily, with volume supporting the rise, and when reactions become shallow, that's when the foundation of a real move is being built. Early price movement is like the first flicker of a flame. It looks bright, but it doesn't yet have fuel. Most traders are emotionally wired to chase motion. They feel safety in activity. When they see the market begin to move, they equate that movement with confirmation. But the market doesn't confirm strength through speed. It confirms it through absorption. The professionals are testing, probing, waiting to see if sellers remain. Only when that supply is exhausted does true strength appear. There's another subtle point here. Early price movement often comes from manipulation, intentional or otherwise. The composite man, as I call him, uses these movements to gauge public sentiment. A quick rally draws in the impatient crowd. It gives large operators liquidity to sell into or to shake out remaining weak holders before beginning real accumulation. When the public rushes to buy the first upward swing, they become the exit door for someone else. You might be thinking, so how do I know when strength is genuine? The answer lies in the sequence. The market must first go through a process: accumulation, testing, and confirmation. After a decline, the first rally is not strength, it's a test. The next reaction shows whether the market can hold. If it does, and if the next rally comes with increased volume and improved price spread, that's strength beginning to show itself. So, instead of buying on the first rally, learn to observe the test that follows. Watch the behavior of volume, the ease of movement, the willingness of price to hold. Real strength has a kind of effortlessness to it. It doesn't struggle upward, it glides, because there's no longer anyone to sell against it. Early price movement fights resistance, confirmed strength meets none. This concept extends beyond charts, it's a principle of all wealth building. Strength in your trading, like strength in the market, is developed through patience and confirmation. You can't rush success, just as you can't force the market to move on your schedule. You must wait for alignment, for the moment when conditions truly favor you. The crowd always wants to act first, the wise trader waits for proof. Every tick on the chart tells a story of behavior. When you see that first upward move, don't let excitement cloud your judgment. Ask instead who is buying, who is selling, what is the purpose behind this motion. Until you can answer those questions, you're not seeing strength. You're only seeing movement. And in the market, movement without purpose is the trap that catches the 90% who buy too early. Patience is the trader's greatest capital, not money. Most people think success in the market depends on having a large account, fast execution, or access to better information. But the real advantage, the one that separates the professional from the amateur, is patience. Money without patience will always find its way into someone else's pocket. Patience without money may wait a little longer, but when the moment comes, it will multiply what it has. Why is patience so rare in trading? Because the market preys on human nature. Every tick, every price change, every candle whispers to your emotions. Do something. The market makes you believe that movement equals opportunity. But the truth is, opportunity only appears for those who can wait for clarity. The impatient trader acts from emotion, the patient trader acts from evidence. One follows impulse, the other follows intention. Do you ever notice how difficult it is to wait when you've just spotted what looks like a good setup? The urge to enter, to not miss out, is one of the most dangerous emotions a trader faces. You think waiting will cost you profit, but in reality, waiting is the act that protects profit. The longer you can wait for the right condition, the stronger your position will be when you finally act. Patience is not inaction, it is preparation. It's the ability to stand still while others rush into noise. Let's talk about the nature of patience in the Wyckoff sense. The market moves in phases: accumulation, markup, distribution, and markdown. Each phase takes time to unfold. The large operators, the composite man, move slowly, building or unloading positions without revealing their intention. A patient trader observes this process. He doesn't try to force trades in the middle of uncertainty. He waits for the structure to form, for supply to be absorbed, for demand to show itself. The impatient trader, on the other hand, tries to buy the bottom and sell the top before the market is ready. Patience in trading means you understand that time is part of price. Every bar on your chart carries information about behavior, not just direction. A market that moves up too quickly without consolidation is unstable. A market that pauses, tests, and holds levels is building strength. The patient trader can see this. He recognizes that the pauses are not wasted time. They are preparation for movement. The impatient trader only sees inactivity and grows restless, wanting to act before the move is mature. Think of patience as a form of capital preservation. Every unnecessary trade is a small withdrawal from your account of discipline. You can lose more by acting too often than by being wrong once in a while. The professional understands that fewer trades, taken at moments of clear advantage, are far more powerful than dozens of impulsive entries. Patience allows you to conserve your financial and emotional capital for when the odds are truly in your favor. Have you ever found yourself sitting through a quiet market, feeling like you're wasting time? That's the test of real patience. The mind starts whispering, maybe I should take a small position just to be doing something. But doing something is not the same as doing the right thing. The market doesn't pay for activity, it pays for timing. Each moment of waiting is a test of your maturity as a trader. Those who pass the test often find the market rewards them not just with profits, but with peace of mind. Patience is what gives you perspective. When you're not desperate to trade, you can see the market for what it really is. A reflection of collective behavior, not a machine that owes you opportunity. The patient trader sees accumulation building and can wait through the tests, the shakeouts, the false moves, because he knows what's being prepared beneath the surface. The impatient trader reacts to every swing, chasing the noise, buying strength that's already priced in and selling weakness that's already been absorbed. The market teaches patience the hard way. It punishes those who move too soon with losses and rewards those who wait with clarity. That's why I often say, the greatest traders are not the ones who trade the most, but the ones who wait the longest for the right moment. You see, patience isn't passive. It's a kind of active discipline. It means you're constantly studying, watching, reading the relationship between price and volume, but refusing to act until the picture is complete. There's also a deeper level to patience: emotional stability. The impatient trader's emotions rise and fall with every tick of the tape. He's constantly chasing comfort, trying to escape the anxiety of waiting. But the patient trader is grounded. He accepts uncertainty as part of the process. He doesn't demand that the market give him a signal every day. He knows that opportunities are created by time, not by need. Have you ever noticed how the biggest moves in the market come after long periods of quiet? The long sideways bases, the slow tests, the dull markets that most traders ignore. That's where the professionals are at work. That's where patience pays off. The impatient crowd grows bored and walks away. They sell their positions or lose interest just before the real move begins. The few who remain, those who have waited and studied the structure, are there to take advantage when the market finally reveals its strength. Patience also applies to how you manage trades. Once you're in a position, the same principle holds true. Most traders exit too soon because they can't stand to wait for the full development of the move. They take small profits out of fear and miss the larger trend. The market rewards those who can hold through noise and ignore the small fluctuations that mean nothing. The patient trader lets the market prove him right or wrong instead of reacting to every minor movement. Patience isn't just about when to trade, it's about how to think. A trader with patience knows that consistency comes from process, not from frequency. He's not trying to make money every day, he's trying to make the right decisions every time. This mindset builds wealth steadily, not explosively. It may not be exciting, but it's enduring. So when I say patience is your greatest capital, understand that it's not a poetic phrase, it's literal. Every moment of restraint is money saved and money positioned for future opportunity. The trader who waits for confirmation, who allows the market to reveal its intent, is always in control. The one who trades from impatience is at the mercy of his own emotions. In trading, time reveals truth. It exposes weakness, confirms strength, and rewards discipline. Money is what fuels your trades, but patience is what fuels your success. Without it, every dollar becomes a tool for self-sabotage. With it, even a small account can grow into something substantial, because patience aligns you with the rhythm of the market instead of fighting against it. The crowd buys from emotion, professionals buy from evidence. This single truth defines nearly every transaction in the market. It separates those who survive from those who are devoured by their own impulses. The market, after all, is not a place of fairness. It's a reflection of human behavior, and human behavior is ruled by emotion. When you understand this, you start to see that the market's greatest illusion is excitement. It's the energy of the crowd that pushes prices in bursts, but it's also that same energy that blinds them to what's actually happening beneath the surface. Most traders act because they feel something. They feel excitement when prices rise, fear when they fall, and regret when they miss out. The professional feels none of this. He watches the same chart, the same price movement, but he doesn't interpret it through emotion. He studies it through evidence, price, volume, spread, and time. While the crowd rushes to act, the professional waits for the story to make sense. He knows that emotion moves faster than truth, and that's where his opportunity lies. Do you ever catch yourself buying simply because the market feels strong? That's the crowd's voice inside you. It's the same voice that tells you to act now before it's too late. But ask yourself, too late for what? The professionals know that real strength doesn't vanish in a day. If the move is genuine, there will be follow-through, and that follow-through will show in the evidence. The crowd doesn't wait for proof. They react to excitement. Think of how markets form their great turning points. After a long decline, prices begin to rise, and the crowd, desperate for hope, interprets the smallest rally as the start of a new bull phase. They rush to buy, but professionals are not impressed by one rally. They look beneath it. They ask, is this movement backed by demand or just by short covering? Is volume supporting the rise, or are we merely seeing an absence of selling? They treat every movement as a clue, not a command. The market gives constant evidence for those who know how to read it. A price rise without volume means little. A price holding steady after a test of support means much more. Professionals trade based on these relationships. They are like detectives piecing together the truth, using observation and deduction rather than emotion or impulse. The crowd, meanwhile, trades from the gut, responding to every rumor, every spike, every headline. Emotion is quick, and it loves company. When you see everyone talking about a certain stock or market move, that's usually a sign that the crowd is already committed. By the time something becomes popular, it's already late. The professional sees the crowd's excitement not as a signal to enter, but as a warning to prepare for the other side of the move. The market feeds on emotion because emotion creates liquidity. Someone must buy when the professionals are selling. Have you noticed how the market always seems to do the opposite of what feels right? That's not coincidence. That's design. The market rises until the public finally believes it can only go higher, then it falls. It falls until the public gives up hope, then it rises. The professionals are not guessing. They're observing the evidence of emotion. When volume expands on down bars near the end of a decline, and prices stop falling despite the heavy selling, the professional sees absorption. The crowd sees despair. That's the difference. The crowd buys stories, the professional buys behavior. The crowd listens to tips, to news, to opinions. The professional listens only to the tape. He knows that the truth of the market is not in the headlines, but in the relationship between buying and selling pressure. Evidence never lies, even if it speaks quietly. Emotion, on the other hand, always shouts. It demands action without understanding. There's something deeply human about wanting to be part of the crowd. We seek comfort in numbers, even when those numbers are wrong. In trading, that instinct becomes deadly. When you act because others are acting, you give up your independence. You become part of the herd that moves together and suffers together. Professionals train themselves to detach from that need for belonging. They build confidence from study, not from consensus. Do you ever find yourself checking social media or chat rooms to confirm your trades? That's the subtle pull of emotion. The professional doesn't need confirmation from others. He gets it from the chart itself. Evidence is all he requires. He measures the market's strength by how it behaves on reactions, by how it tests levels, by whether demand steps in at the right time. Every decision is built on observation, not opinion. The difference between emotion and evidence shows most clearly during tests. The market often shakes out weak holders to see who's still willing to sell. The crowd panics during these moments, thinking the move is over. The professional watches carefully. He knows a test is not the end of a move, but part of its preparation. If the test comes on low volume and prices hold firm, that's evidence of strength. While the crowd is selling in fear, the professional is quietly accumulating. Emotion seeks instant results. Evidence requires time. The crowd wants to make money now, today, this hour. The professional wants to make money correctly. He doesn't care if it takes days or weeks for the setup to mature. He knows that trading success doesn't come from speed, but from synchronization, aligning his actions with the market's rhythm. The impatient always lose to the patient. Emotion is blind to structure. The crowd sees every rally as a beginning and every decline as an ending. Professionals see phases: accumulation, markup, distribution, markdown. They understand that price movement must have purpose and preparation. They wait for evidence of that preparation before acting. When the crowd buys strength, professionals are selling into it. When the crowd sells weakness, professionals are buying it. They are always on the opposite side of emotion because they trade from logic and structure, not reaction. There's also a mindset difference. The crowd trades to feel good, the professional trades to be right in process. The crowd chases excitement, the professional seeks understanding. The crowd celebrates every win and mourns every loss. The professional studies both for evidence of behavior. Emotion ends in exhaustion. Evidence ends in knowledge. To trade from emotion is to be part of the market's fuel. To trade from evidence is to harness that fuel for your own advantage. Evidence tells you when the tide is turning long before the crowd realizes it. It shows you accumulation when others see stagnation, and distribution when others see momentum. But to see that, you must let go of the need to be entertained by the market. You must treat it as a study, not a thrill. So when you look at your next chart, ask yourself, am I seeing this through the eyes of the crowd or the eyes of a professional? Am I reacting to excitement or observing the evidence? The answer to that question determines which side of the trade you stand on. The side that feeds the market, or the side that profits from understanding it. Wealth builds by waiting for confirmation, not chasing movement. This is one of the hardest truths for traders to accept, because it goes against the very instincts that drive people into the market. Everyone wants to be early. Everyone wants to catch the bottom or sell the top. But the irony is that the real money, the steady wealth that compounds over time, comes from those who wait for the market to prove its intention. Chasing movement may bring excitement, but confirmation brings consistency. And in trading, consistency is what wealth is built upon. The market constantly tempts you to act. It flashes signs of life where there is none. It stirs emotion with quick rallies and sharp drops. For most traders, that's all it takes. A few strong bars, a burst of volume, a sudden headline, and they jump in, afraid to miss what looks like opportunity. But in reality, those bursts of movement are often just noise, created by short covering or momentary imbalance. They are the traps that the patient trader avoids. The market will always reward the one who can wait until strength is proven. Do you ever feel that pull to enter as soon as you see price start to move? That's the fear of being left behind. It's what drives the 90% who fail. They mistake motion for momentum. They think that catching the beginning of a move means catching the profit. But the market doesn't pay you for being first. It pays you for being right. Confirmation is what makes you right. It's the evidence that demand is real, that supply has been absorbed, that the market is ready to move with purpose rather than emotion. In Wyckoff's principles, every move in the market follows preparation. There's accumulation before markup and distribution before markdown. The composite operator, the professional money, never acts in haste. He tests, he waits, he absorbs supply, he manipulates the public's expectations. Then, and only then, does he allow the true movement to begin. The crowd, unable to see the structure, reacts to the surface. They buy the first rally off the bottom or sell the first decline from the top. The professionals wait for the market to confirm that the campaign is ready. Confirmation shows itself through the relationship between price and volume. A rally that holds its gains on decreasing volume during a reaction, that's confirmation of strength. A test that fails to break the previous low on light volume, that's confirmation of absorption. A breakout that comes with expanding spread and volume, that's confirmation of demand. These are the footprints of the composite man. When you see these, you're not guessing, you're following the evidence. Chasing movement, on the other hand, is emotional trading. It's built on impatience, on the need to act, to prove something. Every trader remembers the times they missed a move and felt regret. That memory shapes their next decision. They jump in early next time, trying to avoid the feeling of missing out, and the cycle repeats. They end up buying into weakness or selling into strength because they didn't wait for proof. The irony is that missing a move is never as costly as entering without confirmation. Wealth in trading is not created by how often you trade, but by how selectively you trade. Every position should be based on confirmation that the market has completed its preparation phase and is ready to trend. This kind of trading doesn't require predicting the future. It requires recognizing behavior. When you learn to wait for confirmation, you align yourself with the professionals, not the crowd. You no longer react to price, you interpret it. Have you noticed how the market often pauses before a major move? Those pauses are the tests. They separate those who can wait from those who cannot. When a stock consolidates quietly after a rally, the impatient sell out, thinking the move is over. The patient recognize that the market is resting, gathering energy for another leg up. The professional doesn't mind waiting through these periods because he knows that true strength takes time to reveal itself. Wealth comes from holding through preparation, not from chasing excitement. Chasing movement creates noise in your trading account. Lots of activity, little progress. Waiting for confirmation creates harmony. Fewer trades, higher accuracy, steady growth. The crowd's money changes hands every day. The professional's money grows silently over weeks and months. That's why you'll often find the largest profits come from the trades you waited longest to take. The setup matured, the evidence aligned, and when you finally entered, you were trading in sync with the market, not against it. Wealth also builds mentally through confirmation. Every confirmed trade reinforces discipline. It teaches you to trust process over impulse. Each time you wait for the market to prove itself, and it does, your confidence grows. not the shallow confidence of excitement, but the deep confidence of understanding. That confidence compounds just like your capital does. It becomes your edge. Think of confirmation as a dialogue with the market. The market makes an initial statement, a rally, a breakout, a test. You don't respond immediately. You wait for the reply. Does the market confirm its statement? Does it show continuation, absorption, follow through? If it does, you act. If it doesn't, you stand aside. Most traders interrupt the conversation too soon. They jump in before the market has finished speaking. The professional listens until the message is clear. Wealth is patient. It doesn't grow in bursts. It grows through discipline, repeated over time. Each confirmed trade is like laying another stone in a strong foundation. Chasing movement is like building on sand. You might see progress, but it collapses under pressure. The traders who last in this business understand that the best opportunities don't demand attention. They quietly earn it through confirmation. Do you see how this applies beyond the chart? In your trading life, every big success is preceded by patience. Waiting for the right strategy to align with your temperament. Waiting for a setup that matches your criteria. Waiting for the market to give you permission to enter. That's the same principle. Wealth, whether in the market or in life, accumulates through restraint, not reaction. The crowd always wants immediacy. They want their money to grow like their emotions. Fast, dramatic, constant. But the professionals know that speed without structure is chaos. They would rather make fewer decisions, each one grounded in confirmation, than chase every flashing light that crosses their screen. That's how accounts grow steadily rather than swinging wildly between gain and loss. Confirmation is more than just a technical signal. It's a mindset. It's the discipline to demand evidence before committing risk. It's the humility to admit that you don't know until the market tells you. When you operate this way, wealth becomes a byproduct, not a pursuit. You no longer chase movement. You let movement mature into confirmation, and confirmation mature into opportunity. And that is how trading transforms from guesswork into mastery, from fleeting excitement into lasting growth.